January 23, 2008, the world's largest French bank, Societe Generale, announced a loss that would have shaken the very foundations of modern finance, a staggering Euros 4.9 billion vanished in a single night, the product of a single junior trader's hidden bets. Jerome Kerviel was not a legend in the making. He was a 28-year-old with a modest background, raised in the suburbs of Paris, who entered the banking world as a clerk in the back office of the Delta Fund Management Unit. Ambition, sharp intellect, and a restless hunger for the fast-paced world of derivatives propelled him from clerical duties to the coveted floor of the Global Markets Division, where he became a veteran of the trading desks that handled futures, options, and forward contracts on European stock indices. Societe Generale, like many of its peers, thrived on the thin margins of high-frequency, high-leverage trading. The bank's internal controls relied on a complex web of limits, approvals, and automated monitoring systems. Yet beneath this facade of rigor, a culture of aggressive profit-seeking often celebrated risk-taking, and the pressure to deliver outsized returns was relentless. Kerviel, eager to prove himself, began to test the boundaries. He discovered that the tri-party settlement system, the mechanism that reconciles trades between counterparties, could be manipulated by creating fictitious offsetting positions. By entering fake, hedge, trades in the back office, he could disguise the true exposure of his speculative bets. From 2005 onward, Kerviel quietly built a layered web of unauthorized positions, using the bank's own capital to amplify his wagers on the Euro Stoxx 50 and other index futures. He exploited the forward selling of securities, fabricated transaction confirmations, and even altered computer code to bypass the bank's limit-checking software. The result was a massive, hidden portfolio that, on paper, seemed balanced but, in reality, represented a concentrated bet that the market would move in his favor. The house of cards began to wobble in early 2008 when the global markets turned volatile after the collapse of Lehman Brothers. Prices moved against Kerviel's positions, and the hidden exposure could no longer be masked. On January 22, alarms finally rang within Societe Generale's risk management team. The bank's fraud detection unit uncovered irregularities, mismatched trade confirmations, impossible settlement dates, and a staggering discrepancy between the bank's reported exposure and the actual risk. By the next morning, senior executives were confronted with the reality that Kerviel's unauthorized trades had amassed a notional value of more than Euros 50 billion, a figure that dwarfed the bank's entire market-making operation. The fallout was immediate. Societe Generale's shares plunged. Investors demanded answers, and regulators across Europe launched investigations. The bank announced it would seek to recover the losses, filing a civil suit against Kerviel for breach of trust, fraud, and forgery. Kerviel, arrested on the same day, maintained that he had acted alone, that his superiors were either complicit or willfully blind, and that the bank's culture had encouraged him to push the limits. The criminal trial began in June 2010, a courtroom drama that captured the attention of a public still reeling from the financial crisis. The prosecution painted Kerviel as a mastermind who deliberately undermined the integrity of the financial system, emphasizing the sheer scale of the fraud and the risk it posed to the global economy. They presented emails, system logs, and testimony from former colleagues who described Kerviel's methodical approach to forging documents and manipulating the settlement system. The defense, led by a seasoned team of attorneys, argued that Kerviel was a scapegoat, a junior trader sacrificed to protect senior management and the bank's reputation. They highlighted internal memos that praised aggressive trading, the lax supervision of the Delta desk, and the fact that risk control systems had been disabled or overridden with the tacit approval of higher-up managers. Witnesses testified that the bank's culture rewarded big wins and turned a blind eye to red flags, creating an environment where Kerviel's actions could flourish. After weeks of testimony, the jury delivered a verdict that echoed the gravity of the case. Jerome Kerviel was found guilty on all counts, including breach of trust, forgery, and unauthorized use of the bank's funds. The court sentenced him to 5 years in prison, 3 of which were suspended, and ordered him to repay the full Euros 4.9 billion loss. In a symbolic gesture, the judge also imposed a fine of Euros 2 million, underscoring the principle that financial crimes must carry a heavy moral and monetary price. Kerviel appealed the decision, arguing that the repayment clause was impossible to fulfill, and that the sentence failed to consider mitigating circumstances. In 2012, France's highest court upheld most of the conviction but reduced the prison term to 3 years, all suspended, and dismissed the demand for full restitution, citing the impracticality of forcing an individual to repay billions. The court, however, maintained that the symbolic judgment served as a deterrent to future market abuse. The aftermath reshaped the banking landscape. Societe Generale instituted a sweeping overhaul of its risk management architecture, introducing real-time monitoring, stricter segregation of duties, and a cultural shift toward compliance over profit. The scandal prompted European regulators to tighten oversight of tri-party settlement systems and to impose harsher penalties for unauthorized trading. Across the continent, banks reevaluated the balance between trader autonomy and supervisory control, leading to the rise of single-point accountability frameworks that aimed to prevent a repeat of Kerviel's clandestine empire. For Jerome Kerviel, the personal cost was severe. Subscribe to the verdict for more stories like this.